Hey, good morning, Carl. How you doing today?
I'm doing great, Mike. How are you?
I'm great, thanks. Hey, welcome to the number one radio show on the air, the Multifamily Unplugged, where you get real, relevant, up-to-date news and daily answers to your questions, unscripted, unplugged, and raw. Just the way people like it, right, Carl?
Oh yeah, that's the only way to have it.
That's for
That's the only way to have it.
So what's going on this week, Carl?
Well, it's been an interesting week. I've talked to a couple people about buying property with no money, which I know is what we're going to talk about today, right? A buddy of mine who lives up in Grand Rapids asked me about that. He said he's never actually, I take that back. He owned a piece of property about 20 years ago, and then he hasn't owned a piece of property since. And he just out of the blue said, "Hey, can you buy property with no money?" Because
Hmm.
he knows I used to do that, so it's perfect. And of course, he's on a plane today, so he couldn't make the call. But I said, "Yeah, you got to make our unplugged call because that's what we're talking about this week, right?"
Yeah, right. So listen, it's interesting you bring that up. I got to think big. And one of the things I always talk about is all the seminars I've been to, the training and the coaching events and everything. But the first seminar I ever went to was a Robert Allen seminar. Robert Allen was famous for this. He said you could buy real estate with no money down using OPM, other people's money, right? So he made a challenge, or he was challenged by the St. Louis Tribune. And this is going back almost 30 years now. Robert Allen's not really around anymore these days. A couple of his books are still on the market, and they're good investing books. Nothing to get too crazy about, but here's what they did. They challenged him. They said, listen, we're going to take everything from you. We're going to drop you in any city in the country you want to go to. We're going to give you $20. And by the end of the weekend, do you think you can buy real estate? He said, by the end of the weekend, I'll have 3 deals done. So come Monday morning, remember now, Friday, they drop him in the middle of St. Louis. He lived like in LA or somewhere like that. He not even familiar with the Midwest. He gets dropped in St. Louis with $20 in his pocket and his driver's license. And by the end of the weekend, he had 5 houses under contract and he had $400 in his pocket.
I remember
So, so that was the first seminar I ever went to. So can people buy deals with no money down? They certainly can. And I have to talk about this right now. In October 15th through the 17th, we have the Multifamily Global Summit coming up. And one of the speakers, actually the first speaker on the first day, is Chris Hake. And Chris talks about buying a 32-unit apartment complex with no money out of his pocket. And he owns that and operates it today. So listen, if you think it can't be done, it can be done. And we're going to have a guy on the summit who's actually going to talk about it and show how he did it. So I'm
Yeah.
really glad that you actually brought that up this morning, because I would have never said anything about that. That's what happens when we do things unscripted and raw.
Yeah. Well, yeah, exactly. Well, and I remember Robert Allen. I remember him. He's probably 80 now, but here's what while you were talking about that, Mike. Here's the thing that I love about real estate. Real estate has been around forever, right? And so as long as people have been living in caves and living in buildings, people have been dealing real estate. So, buying real estate with no money is not something new. People have been doing it for generations, right? And I'm a perfect example. Every building I bought, I did with partners, and every building I bought, I did not put a nickel of my own money in. And these were the smallest. I mean, outside of like condos or like a cabin. I'm talking about like multifamily properties, which is what we're talking about. The smallest one was 10 units. The largest one, I never got up to your size, but the largest one I think was about 28 units or 32. I can't remember. But my point is, I put the deals together without any of my own money. So what did I bring to the table, right? What value did I bring? And this is an important point for anybody that's listening. You can bring value beyond just hard money, just money,
Yeah.
right? I mean, I would go out and find the deals, right? I would do all the legwork, right? Just like Robert Allen did, right? He knocked on doors, whatever he did. I would find the deals. I had the contact for the financing, right? So I'd put
Yep.
all the financials together. I put the LLC together. I did all those other things that my investors didn't either know how to do or didn't want to do. And that was the value that I brought to the table. And by the way, I would structure the deal so that, I was the managing member of the LLC, right? And I would have at least 55% of the membership interest. In other words, I controlled the deal, right? And
Yeah.
so it's absolutely doable. And I know Chris is going to talk about that. And that's I'm glad that you put him on day one, because that's, I think, why a lot of people are going to pony up the $9 or whatever it is for the, just that session alone is going to be worth it.
Yeah, see, here's the twist too, right? Is what you're talking about is syndications, right? And most syndicators or sponsors, that's how they do their business, right? Percentages might be different, and cost of capital is different, and how much they put in. We used to do our deals with either no money out of our own pocket or 10%. We'd be in the deal for maybe 10%.
Right.
And listen, when you take the risk because you're signing as the guarantor and you are doing all the operations and you're running the property, you should get a little bit more flexibility on the out of pocket, right? Here, listen, I always tell people, Carl, and you know this, I've talked to you about this. You find a good deal, the money will show up.
Yep.
It shows up.
Yep.
And what you're doing is you're offering something to people that they can benefit from. So, hey, go ahead.
Yeah, and it's what are you focused on, right? If you focus on the lack of money, right? If that's what you focus on, you're not going to get anywhere, right? If you focus on what you bring to the table, that you can go out and do the legwork, right? Like you talked about, you can bring the deal to the table, you can find the deal, analyze the deal, you package it up. The people and the money will come. I mean, you and I both know that, right? I mean, good deals don't chase money, right? Money chases good deals. So if for any of you that are listening, focus on what the value and what you can bring to the table. And if it's not money, then don't focus on that. Focus
Right.
on what you can bring and what you have control over. And that's, for sure. I mean, and I know that you know that. So for anybody that's listening that doesn't know that, that's what really my advice to you.
Yeah. And listen, can we back up for a minute? And not that we're not going to talk about this subject anymore, but there's two things we have to do. First, I want to just welcome everybody to the show this morning. We didn't really do that. Good morning, everybody. Glad you're here. Listen, a little housekeeping thing. Remember, you only have to register once. So you get the link, you go to Zoom, you register. Now you have the same link. We're the same link every time. Just save it in your saved emails, or put the link in a special place, but you have it every time for every Saturday morning. So that'll work for everybody, just so you remember. But you only have to register once. So if you don't like registering and things like that, you only have to do it once. So we're glad that people are here, and people have been registering and coming, and we've been having comments during the week and talking to people during the week. And it's pretty good because, I think that we're coming to the table with information people can learn from and grow from, right? And that's what it's about. How do we help people learn and grow? It's like, I have two topics this morning that I think are a little relevant for where we're at in the marketplace. And so let's take the news this morning, and talk about that, and then we'll come back to this other subject, right?
Okay, good.
But here's the first thing, Carl, and you and I had already talked about this a little bit, and you thought, oh, geez, might be a little over somebody's head. And I said, well, not really, because here's my philosophy about education, right? You can never have enough. And if you treat yourself like a rubber band, and every time you expand a rubber band, it never goes back to its same elasticity, right? So if we put relevant information and new information and things you don't know into your brain, it's never going to go back to where it was. And you're going to learn more and be able to retain more as a result. So we're going to talk about A-class property this morning in one of our topics. And let's just, so people understand, multifamily is classified in 4 categories: A, B, C, and D. The same with the markets that those multifamily properties are in: A, B, C, and D. A is your upper end property, your newer property, probably just built. Here's the interesting thing about A-class property, and I'm not going to get into a ton of education this morning on this stuff, but an A-class property is generally owned and operated by big money. Big money being your insurance companies, your hedge funds, your teachers' funds, your pension funds. When you look at Harvard pension or Harvard endowment, they own a ton of real estate around the world, right?
Right,
You
right.
look at the unions. The union pension funds own tons of real estate, so they're relevant because this is what they do. They buy A-class property. They buy it because they don't have to do any repairs. It's very low maintenance. It's an operational play. They can buy this brand new property that just got built by a developer. The developer makes money on the way out. They make money on the way in. They get, it's probably only got a 4, maybe a 4.5 cap rate today. And cap rate, there's a whole nother conversation, but let's just say this, that return on their investment is 4%. They have investors in the deal, and they have to pay their investors through annuities and their returns 2.5 or 3%. And they keep the difference. It's a very simple mathematical equation for how they run and operate these deals. And that's what a Class A is.
So how does that impact? How does that impact the smaller people? Because you and I talked about that.
Yeah. So here's the deal on the conversation. I was just laying out Class A property, right? So the title of this article was "Coronavirus disrupts and stalls Class A rental growth." So the virus, where we're starting to see a stall come up in Class A rental growth. So what that means is you've got who lives in those upper end properties. You got managers, middle management, upper management that live in those types of properties, right? Well, they can't raise the rents anymore because these guys aren't working, because things are closed down, things are, not back to full speed. So the health crisis is altering apartment demand and interfering with leasing as some renters relocate to other areas of financial needs and desires. So they're jumping from Class A's to Class B's. Why? Because the rent is less expensive.
Right.
Because they can get almost, if I buy a Class B property today, I'm putting CapEx money into it to increase the opportunity to raise my rent, right? So if I can attract that Class A property owner into my Class B product for a little bit less money, I'm doing that all day long, because now what I have the ability to do is I have the ability to push the rent a little bit more. So Class A units fell 1.5% nationally between the first and second quarter of this year. That's 60 basis points when you start to look at lending criteria. Tenants seeking lower cost or more spacious residents help push Class A vacancies to an 80% to a 20% factor in the second quarter because of lack of income, which has helped Class B and C properties grow. Their rents come up, the stability in those markets come up, and the stability in the rentals come up. About 23,000 more apartments have opened in the first half of 2020, which is less than, about 50% less than what had opened the first half of 2019.
Is that in Chicago or nationwide?
That's nationwide. Those are nationwide numbers. Yep.
Yeah.
So it's interesting what the virus is doing right now. I talked to a guy the other day. He said, I had the best July of my life. He's a Class B value add syndicator, buys value add properties, goes in, fixes them up, deals specifically with working class clientele. He said, I had the best July of my life. Right? I said, how do you have the best July of your life when half the world is shut down and you got people not going back to work in your category? He goes, people are finding money. And he said, it's just been an interesting process. But this article tells us that. Tells us that Class A's drop. You're putting more people in a Class B product. The occupancies are going up. Rents are going up. overall, you're in a better position in a B or C deal today than you would be in an A.
Yeah, that's awesome. And you know that for again, for those that are listening, you know, all those, you know, I always look at money and real estate like equilibrium, right? So you're seeing downward pressure on the A category, right? That higher rent that you talked about. So what does it do? It pushes up the lower. So people that are normally investing or renting those higher end properties are going to be pushed down into the B's and the C's, right? And that's, you know, that's where guys like, you know, because you and I are not a REIT or an invest or a pension fund or a endowment, right? So, I mean,
Right.
you know, we're either syndicators or we're individuals that are finding partners. That's where it starts to impact us. You know what I mean? And that's really relevant because that's a good outlook for somebody that's owning a 10 flat or an 8 flat or a 16 unit building. You know, especially in a place like Chicago or major metropolitan areas. So that's really interesting.
Yeah. So the thing that I like about it is that the displacement, right? So now what that will do, now you have to watch what the next factor of that'll be. So the next factor is going to be that it's going to slow down new starts. So you're going to have a backlog of new starts. So, because what's going to happen is they're going to finish what they have on the market, the developers, right? And those products are going to come online. Then there's going to be that gap because nobody's going to be starting because they know that there's um, uh, nobody renting them. So, because that has gone down, right?
Yeah,
It's a
exactly.
displacement. It's a displacement. So, let me ask you this out here, and I know your background is in money and banking. So, how does that affect the pricing of of a loan today? So, this whole piece right now, how will that affect the bank pricing?
Well, that's an interesting story. So you know, a lot of people don't really understand how banking works, and then you throw in the human factor, right? The Fed and the director of the Fed, right? So that's the wild card. However, you know, the banks make their money and earn their money on a margin, right? It's usually a couple hundred basis points, right, or two points, right? And they do it by lending money. That's where they actually make their money. So every dollar that you put into a bank, they can lend out $10, right? So that's why they're always very concerned about deposits. And just as a sidebar, if you're ever talking to a banker and you want to get their attention, talk deposits because that will get their attention. That's what drives their entire business, right? So a couple different things. New construction loans are going to be out the window because you're right. These developers are going to take it. They're going to sit on the sidelines because those projects take 2 to 3 to 5 years to mature, right? And they're going, well, geez, you know,
Right.
there's going to be, as you mentioned, some compression and some, you know, they're going to take some time off. So what the banks are going to do is if they're not lending 100 million to someone like Steve Fifield to build another 300 unit apartment building, they're going to start to make those loans more attractive for the smaller investors, right? So they're going to start, I think they're going to start to drop rates. I think rates are going to come down. You know, they're still going to make their margin because they always do, but it's all about attracting borrowers because that's where they earn their money, right? And so I think this is going to have, and again, this is just my opinion, right? I mean, there's a lot of different factors, but I think mortgage rates are going to come down. I think not only for single family homes, but also for apartments. And remember, you know, I think we talked about this before. Bankers look at 4 flats and below as residential. 5 flats and above are commercial. So if you're looking at a 5 flat or above, it's a commercial loan, right? 4 flat and below is a residential mortgage. So they're analyzed differently. They're underwritten differently, right? The risk variables are different. So it's a different, that's the break point across the board in the United States is 5 flats and up are commercial. I think the commercial loans for apartment owners are going to go down. I think they're going to drop.
So that's interesting because that's not what the feds are saying.
Yeah.
All right. So, and I think what you're talking about is in your typical standard type of market economy, even maybe coming out of a recession. But we're in this pandemic thing right now. And as a result of that, I think there's so much more uncertainty, right? And I don't know that the banks, as well as the Fannie and Freddie know how to price anything. But
Right.
here's the next article. Mortgage fees are set to increase in September. I mean, that's the headline, right? Fannie and Freddie will add an adverse market refinance fee to mortgages on September 1 to offset uncertain expenses and risks due to the pandemic.
So they're talking about fees, not rates, right?
Yes, their mortgage fees are going up, not the rate. You're right. It's on the mortgage fees. So they're going to, and what they're saying is they're going to increase mortgage fees $100 per every 100,000
Right.
Of borrowing.
Right. Right.
So I found that to be really interesting because are they raising the fees because there's not enough going on? Why exactly would they be doing that? Because if they're going to lower rates and raise fees,
Right. And there's a lot, like you said, there's a lot of variables out there. I mean, they're adding fees to things now. I mean, what did I do? I rented a car or something. There was a cleaning fee that I never had to deal with before, right? Because now it's costing more money to have someone sterilize the car, I guess. So there's all kinds of uncertainty and crazy. But and Mike, I don't know. Maybe this is a good question for you. I used to pay attention to our mortgage rates, but I was more about getting the deal done. So if there was a community bank or a lender that was more that allow us to be a little bit more creative or was a little bit more relaxed in some of their underwriting criteria, like for example, their reserves, right? Or their debt coverage ratio, right? I was more concerned about some of those variables, and that might be a little bit over the heads of some of the people on the call. But those are some of the other things that go into a loan. I was always more concerned about that in getting the deal done than I was at a half a point here or a half a point there. Does it matter? Absolutely, 100%. There's no doubt about that. However, there's a lot of different variables, and maybe that should be a topic of a future call that we have. Who are we having on in a couple weeks? Don't we have a guest coming?
Yeah, we have.
Is that Chris that's going to be here?
No, September 12th, we have Lamel McMorris.
Right.
He's a developer in Chicago who is single-handedly trying to turn around a blighted neighborhood.
Oh, right.
So he's a very interesting guy. So
yeah.
Here, let me just cover a couple things. I want to first remind everybody, if you have questions, drop them in the chat. If you need anything, drop it in the chat. And the other thing, and you alluded to this, but I've never really paid attention to mortgage rates because it doesn't make a difference. What is it? $8 a month on a 0.5% on a residential mortgage. Who cares if one bank can give you 4% and another one can give you 4.5%? If the guy at 4.5% is going to service you better and be more flexible and your terms are better, take the 4.5%. Why beat somebody up over 50 basis points? It doesn't make any sense. But here's what I remember. I went into the real estate business in 1991. And I came in the business and the expression was property is selling and the signs are still vibrating. And what that meant was they were putting signs in the ground. The sign installer was walking away. The signs were still vibrating from the installation, and there were offers on the property. We just came in the early 90s out of high interest rates. They dropped like 2 or 3%. And, in 93, the interest rates were 9%. And that was low.
Yeah.
I mean, historically, when our parents were growing up, they were 3%. And now today, again, you could get a mortgage for 3%.
Remember when they were 18? Remember when loans were 18%?
God, I remember when they were 21.
Yeah.
So, yeah. So, people, interest rates are funny, but here's what I know. You can make money in real estate in a good market, and you can make money in real estate in a bad market. Okay.
Yeah.
When rates are high, rates are low, pricing's high, pricing's low, you can make money on both sides.
Right. And again, I totally agree with you. I'm going to go back to what I said before. You really want to focus on what you focus on, right? I mean, don't focus on the fact that you don't have a boatload of money. Focus on bringing value. Don't get myopic about interest rates, because if you've got a good deal and you've got a good banker, go with it, right? And to your point exactly, a half a point here, a half a point there, it's not going to make a difference. And you and I both know that, right? Because we've done all the deals that we've done. But for someone that's just looking at it, don't waste time and energy, to a fault, worrying about a half a point here or half a point there. Like you said, if you've got a banker that's working with you, that's flexible, that's going to give you great service, that's going to be there when you need them, right? Or has better underwriting criteria, or is going to maybe pick up some of the fees. Maybe they're going to pay for the appraisal. Maybe they're going to pay for the survey, right?
Right.
Those things add up. So 100%. Are interest rates important? Of course, but don't get myopic.
Yep. And you just brought up a couple of things. You slid them in, and I'm sure that the people didn't really pick up on it. So I'm going to just kind of reiterate this. If you are buying a residential deal or even a commercial deal, ask the seller to participate. And I am really big on asking sellers to participate. Here's how that looks. Write this down, you guys. Some of the things to ask a seller to participate in is ask them, if you're doing a government-backed loan, an FHA or a VA, ask them to pay the points. Ask the seller to pay 2 or 3 points. Whatever's left over, and maybe there's no points on the loan, it can be used for closing costs. Ask the seller to kick back $2,500 towards closing costs. Ask the seller to pay specific fees. On the title charges on a loan, when you do a residential or a commercial loan, there's title charges for both the seller and the buyer. Ask the seller to pick up all the fees. Listen, what's the worst that can happen? He could say no, right? Just ask. You're not going to know unless you ask, right? I think the greatest book ever written says, knock and you will receive.
Yeah, yeah,
So,
yeah, exactly. I mean, I totally agree with you. We used to ask them it's negotiating, right? It's negotiating, and I'm sure one of your modules talks about that, right? Talks about closings and all that kind of stuff.
yeah, writing offers, and yes, yeah.
I mean, that's key, because that adds up. $2,500 here, $500 for the attorney. $900 to cover the water certification, right, with the title company. That all adds up, right? And even the commissions. If you're representing yourself, and a seller has an agent, I would tell them, I'm not paying your agent's commissions. I'm not paying 4% on this deal. On $1 million deal, that's $40,000. I said, I'm not. There's no broker involved. I don't have a broker. If you want to pay your broker, you pay him, but I'm not paying him, because remember, the seller, all the money the seller collects is from you, right?
Right.
That 40,000 that goes to the brokers is you're actually paying for that. You're borrowing that money, or you're putting that money in, or your investors are putting that money in. So that stuff adds up, and don't be shy about that. I mean, like you said, ask and you shall receive. If you don't knock, that door will never be open. So
That's right.
don't be shy about that.
So, somebody just dropped a question in the chat. They said, hey, how much equity did you get when you put no money into a deal? Then they said, never mind, you said at least 5%. So, you know what? Every deal is different. So 5% is not a norm, right? Nothing is a norm. Carl said at one point that 50% he got. I did deals where I had 50%, or it was 40, or it was 30. My standard split was, when I syndicate a deal, my standard was that I took 30%, the investors took 70%, and that went cash flow and equity, that went depreciation, and every other line item where income is made. It's a 70-30 split. Now, the interesting thing is, you always make sure that your seller or investor gets paid out first.
Yeah.
and you get paid out last. So if there's no money, you don't get any, right? So that's just part of the offering, is that you give that to your investors first. So I always set those agreements up where it was A class and B class shareholders, and that's how they get recognized as an A class shareholder.
Yeah, well, and that's a whole nother topic that we should probably talk about at some point, about entity structuring, and because there's a lot of different, there's a lot of different ways to hold title, as you're what you're talking about. And I never really syndicated deals at the same level you did, Mike. Our investors, we always had single asset LLCs, which means there was one LLC for each property. We didn't have more than one property in one LLC. And I never had more than three investors. And the time I did have three investors, it was a husband and wife. So
Mm,
it was really two parties. One of those parties had two people, a husband and wife. So my deals were always not as sophisticated as yours. And there were different different levers. However, I will agree with you. Regardless, you should always take care of your investors first, for sure, and
right.
and make them a priority, because at the end of the day, if you do more deals, you're going to want happy investors. And there's every deal, as you mentioned, is different. Every deal gets structured a little bit differently. So that's one of the other exciting things about it. You can structure a deal differently. I want to talk now about partners real quickly. And I know
Yeah.
we're probably getting a little bit long in the tooth here, but that brings me to partners, right? So when you set your criteria or criterion, right, for your property, and you set how you want to structure the deal, that's important, because you want to go in when you're talking with an investor. You want to have all those concerns and all those things laid out, because otherwise they're going to wag your tail, right? If you don't have
Yeah.
those things lined up ahead of time, what type of entity, what the breakdown is, who's managing it, how the income's going to flow, how you're going to break up
Yep.
expenses if you have to put a new roof on a building, right? All of those different things. If you walk into a meeting with an investor, you don't have that laid out, they're going to lay it out for you in their favor, right? And a lot of times, and I'm sure you can appreciate this too, Mike, a lot of times we'd lay it out the way we wanted it, our program, because remember, it was our deal. We were bringing the deal to the table, right? We were bringing them something, right? If they didn't like the deal and it was beyond our tolerance for negotiating, we'd just walk away. We'd find a different investor,
Yep.
so don't get myopic about, you've got to get this investor, because if it's not the right investor, it's like getting married. If you get into a marriage, it's literally like getting married, because right?
Yeah.
You're,
And here's what I say: don't ever feel like you can't say no to an investor.
right.
There were a number of times where, so I went to an attorney, and I had a set of documents that cost me $50,000. You don't have to do that, but we were doing large deals. You're doing a small residential, small multifamily. It's not going to cost you that great amount of money, but we could bake that money into the deal, right? So that paperwork, the first time I did it, cost me $50,000 for a bigger property.
Yeah.
And I'll never forget this. I had an investor, this was probably my third deal in, who said, well, I don't like this, like five different points in the agreement, in the private placement memorandum. And I said, I'm not changing it. He said, well, I'm not investing. I said, that's okay. I said, he goes, you don't want my $250,000? I said, you know what? I'd love for you to invest in my deal, but I am not going to change my standards for you. I already have X amount of other investors, and I don't change my standards for anybody. This is what we've built into our business. So I talk about that because standards are really important, and I talk about standards with my coaching clients all the time about, hey, whether you're renting, whether you're buying, what's your avatar. We have an avatar for a specific type of renter that I'm looking for in a property, the type of person that I want to walk through the door. So when they walk through the door, I ultimately know who they are. And I
Yep.
know, right? It's the same thing when you go to buy a property. Know exactly what you're looking for. Because if you pull in the driveway and you go, oh, this isn't my avatar, then leave. Don't be married to anybody or anything.
Yeah,
Um,
yeah, I totally agree with you. And with
yeah,
investors, Listen, that is so important. You want to vet your investors. You want to make sure that they, that they understand that it's an investment, that they understand that there's a possibility that it's not going to go well. Right? It's an
Right.
investment for a reason, because you want to lay all that out, and you want to make sure, that they understand the program. And I agree with you. Set your standard and stick to it, because you brought up a very good point, Mike. Especially when you're dealing with more than one investor, you can't you can't you know you can't make a proposition to one investor in a deal and then change the proposition for another investor. You'll get yourself in a lot of trouble. And you know sometimes you have to say no. It's okay to say no. What's the old saying? The best deal I ever did was the one I said no to, right? Because I would have lost money.
Right.
And knowing that is really important, especially not only with the property but also with the people that you're going to, you know, I pardon the expression, but get into bed with, right? I mean, because you're going to be tied to that person for the length of that deal. And if it's 5 or 7 years, that can be an awfully long time.
Right. Right. You're absolutely right. And a long time's a long time, especially if you're in a bad deal, right?
Yeah.
Like being in a bad, in a bad relationship.
Well, and it is. It
It
is.
is.
It's a relationship. You know what I mean? And so anyway, that's a whole nother topic. But yeah, you definitely want to focus on the positives, right? You want to focus on your strategy, your standards, and you want to focus on what you bring to the table, because the value is the deal, right? I mean, money is money, right? There is so much money out there. I don't know, in where I'm sitting right now in the middle of Chicago. If I drew a 1 mile radius of my point right now, there's trillions of dollars out there. There's lots and lots of money, right?
Yeah.
So don't ever think that money's scarce, because it's not. And
Yeah.
the good deals will attract the money. So focus on finding the good deals, and the money will find you. You and I
Yeah.
both know that, Mike.
Absolutely. 100%. Well, listen, we got some time left. So, I want to talk about how to find partners, right? So, part of that question that somebody asked a couple of weeks ago was, how do we find partners? And I think that there's a lot of different ways, right?
Yeah.
So, I tell the story that when I was building my investment database, I did an investment seminar in my office twice a week, Tuesday and Thursday night. I would bring 20 new investors each week on Tuesday and on Thursday, 40 new investors a week to see a presentation. I taught a real estate investing presentation, and then I would show a deal at the end, whether one we closed or one we were getting ready to raise money on. And I just built a database. And how do you build a database? One person at a time. You don't go out and build hundreds of thousands of people or thousands or hundreds of people at a time. One person at a time.
Yeah.
So if you can skillfully learn how to um, deal with the repetitive boredom of something. Did you ever see the movie Karate Kid?
Yeah.
Wax on, wax off,
Yeah.
right?
Right.
And he would say to, when am I going to be done with this, right? Well, it's that skillful boredom.
Yeah.
You have to learn how to master the repetitious boredom.
Yeah.
And
Mike.
once you go ahead.
No, I was just saying, you mentioned avatars earlier. I totally agree with you, because I know you built a huge database just doing exactly that. And I used to go to your meetings. I remember you'd have new people every week, because you were providing value, right? It was a valuable meeting. Then the other thing is, you were building a community, right? You build a community, and you're going to find people within that community that are looking for somebody that has the value that you bring, right? And that's one of the things that we're doing with the Multifamily Global Summit. It's not just the training over the weekend, it's the community that we're building, right? And the other thing I want to say, I think I talked about this last week, lay out the parameters of your deal, even if you haven't found the deal yet, right? This is going to do a couple things. Number one, it's going to solidify it in your mind. If you say, I'm looking for, a 5 flat in this area that was, that all the different things, right? It's going to solidify it in your mind. But then before you even find the property, you can go out and start talking to people and say, hey, if I find a 5 flat in Lincoln Park, which is an area of Chicago, that I can buy for $100,000 a door, or two, whatever it is, right? That has a 5-year window. Would you be interested in that? Right? And if they say no, then you say, who do you know that would be interested in this type of return or this type of investment, right? And so my point is, you start to actually cultivate that conversation before you even have a property, right? And we used to do that all the time. And you start to build a list. People are going to say, you're probably going to get 8 people that say, no, I'm not interested in that. But those 2 people, that you get, you can put them on a list and say, okay, great. Well, when I find this property, I'm going to circle back with you, right? And
Yeah.
so you start to build that, as you said, you start to build that database, right? And you always ask, if someone says, I'm not interested, you say, that's when you can, I always just say, well, who do you know that is, right? And oftentimes they say, well, you should talk to my friend or my attorney or my accountant. So, how do you find those people? You have to, first of all, bring something to the table. Even if you don't have the property yet, bring the concept of a specific, don't say, well, I'm investing in real estate, I want 100 grand. People are going to like, well, okay, I don't know what that means. Be specific. I'm buying a 5 flat in Lincoln Park with this, this type of rentals, 2 bedrooms, 3 bedrooms, 1 baths, boom. And then they can focus on what you're focused on, and you're going to find your investors. I mean, that's how we found a lot of our investors, Mike.
Yeah, absolutely. And I totally agree with you. Here's a great script, and I want people to write this down. And I'm just going to role play with you for a minute, Carl. So, hey, Carl, how you doing today?
I'm doing great, Mike.
Good. Hey, listen, I know that you know some people that have an interest in real estate, and right now I have an opportunity to acquire a 4-unit property. And I was wondering who you know who might have an interest in making some cash flow and creating a little bit of equity on the back end. Do you know anybody that I could talk to?
Well, I mean, I might be interested in that. What are the details?
That was a perfect answer. That was the answer I was looking for. Because 90% of the time, if you use the third-party approach like that, people are going to say, whoa, why somebody else? I'm interested. I might be interested. Can I hear about it?
Right.
So, now all of a sudden you open the door of receptivity with the other person to listen to the deal.
Yeah, and I'm asking you, right? You're just presenting the opportunity, right? You never said, Carl, would you be interested? No, you said that third party, which is a great approach. Who do you know, right? Well, what about me, right? So one of 3 things will happen. That's great, Mike. I'm glad you did that, because that's how simple it is. It really is simple. Once you understand that and once you do it, that doesn't mean it's easy, because people are going to have fear of criticism and fear of they're not doing it right and all that kind of stuff. But once you get beyond that, because I know you could do that 100 times at a networking event. I mean, you could literally do what you just did, which took about 30 seconds. You could do that 100 times if there were 100 people there. I know you could, and I can too.
Yeah.
But one of 3 things are going to happen. Either the person's going to respond like I did, right, and say, what about me? Or they're going to say, no, not really interested, right? Or they're going to say, I don't understand what you're talking about, right? I mean, those are basically what's going to happen, right? So if they say, what about me? Boom, you go right into it and you start explaining it. If they say, I'm not interested, that's when you would say, like, if I said, no, I'm not interested, what would you say? What would your response be?
Yeah, you know what? And that's why I asked you if you knew anybody else, because I didn't really think that you would be interested.
Right.
And that's okay, but, do you know anybody else?
Right. Yeah, and that's where I might say, yeah, my attorney, right? Or my accountant, or my brother, right?
Yeah, or you might say, no, I don't know anybody. And I could say, okay, great. Nice talking to you.
Yeah, change the subject, right?
Yeah.
How are the Cubs?
Yeah. Hey, let me ask you real quick. Are there any other notes in the chat that we need to cover?
Let me see here. I haven't been keeping a track of them, but I probably should. How much equity did you, right, we talked about that. Yeah, no, nothing more.
Okay. Yeah, because we're about done anyhow. So, but I want to thank everybody for being here today. And everybody, remember, if you have questions, if you need anything, send us an email during the week. We'll bring it up on the show on Saturday. It was great to be here today. The one last thing that I want to talk about today is the Multifamily Global Summit, which is coming up in October 15th, 16th, and 17th. 3 days of the top real estate speakers in the marketplace. We're going to have speakers that do small multifamily, large multifamily properties, and a lot of ancillary services in between. So listen, you can join the Facebook Live community for $9. Early bird registration is $7, or you can do a VIP upgrade for $90 and get complete interactive opportunity. So you have some really good opportunities coming up, but we're going to have 20 of the top speakers, authors, and developers, everybody from small to large multifamily operators. So it's going to be 3 days of excitement and great information. So
Mike,
I know, go ahead.
I'm putting in the chat right now. Do you know what the website is for them to go and check that out? Because it really is. It's going to be a great event. It's 3 days, like Mike said. It's $9 to join. It's ridiculous, and it's going to be a great 3 days of information.
Did I send you that website this morning, Carl?
Yeah, but I don't remember what it is. You know what? Yeah, I'll send it to everybody in an email. I was going to put it in the chat right now. I know it's mycoreintentions.com.
Yeah, hang on, I got it here. Let me find it.
Yeah, and Chris Haig, as you talked about, Chris, he's the first day. Each speaker is going to go for an hour. Then there's Q&A. We're also doing a cash flow for the VIP. The VIP is really worth it too. There's cash flow. We're going to do a deal challenge, right? We're going to actually see if someone can bring deals to the table and do some deal analysis. There's a lot that's going to go into the weekend. It's not even the weekend. It's Thursday, Friday, Saturday.
Yeah, yeah, there's going to be a lot of exciting stuff that happens.
All right, so I'm typing it in here. Do you have it?
No, here, I got it right here. So.
Are you going to put it in or you want me
Yep,
to?
there it is. I just pasted it in there. That's for the early bird registration.
Awesome.
Yeah.
All right, Mike, what do you got going the rest of the day? I know last week it was your sister's birthday.
Yeah. I'm gonna hang close to home this weekend.
Yeah.
So.
Yeah, I'm gonna get together with the kids and we're gonna go watch a movie and get some pizza or whatever.
Nice.
So, awesome, great conversation, Mike. Always good. And listen, next week I'm more open, so I'm gonna come visit your office there.
Yeah. Let me ask you a question. What's the best pizza in Chicago right now?
Good question. I don't know, man. I like Giordano's. I'm not a thick crust. I'm more of a traditional. But I also like Paisano's. Paisano's has butter crust.
Uh-huh.
It's really good.
Yeah, Lou Malnati's has got butter crust. We ought to talk to these guys and get a little free pizza for plugging their pizza parlor on our show. All right. Hey, have a great week. And everybody have a great week. Look forward to hearing from you, and we'll see you all next week. Bye, everybody.
See you guys.